Yes, we have a concept of what? We have the concept of a compound instrument. Yeah, 15, 10, 20, 22. Compound instrument is nothing but you have, see what is the concept of a compound instrument? We have the concept of means you have the equity as well as the liabilities. Means most of the time, when we say it is compound investment, convertible. They will write the word convertible. Convertible bonds. Is it right? Convertible bonds to equity or convertible bonds to preference shares. Is it? This is the concept which is going to be reflected. Is it right? It happens only with respect to the bonds. Okay. They will never, you cannot convert equity to bonds. You can convert bonds to equity only. Is it right? That is what it says. A financial instrument have the characteristics of both equity and liabilities, such as convertible loans. Either you can convert the loan into equity, you can convert the loan into preference shares. Is right? It is what is the characteristics? What are its features? The features is it is repayable. You have the option. Is that you have the choice? Means if you have the loan, if you have the bonds, you have the choice. Is it right? Option is there. Nobody will force us. Is it right? In shares of the issue company, where we can convert it, we can convert it into the equity shares. Shares equity or preference shares. Is it right? The number of shares to be fixed, issued to be fixed. Is it? They will say, is it for one bond? Is it right? They will say that one bond, you will say it is 10 equity shares. Is it? They will say that yes, for one bond we are issuing how many equity shares? 10 equity shares. For one bond we are issuing 5 equity shares. Is it? Likewise, the lender will accept a rate of interest below the market rate for non-convertible. Definitely, when you are, if it is if it is a non-convertible bond and a convertible bond, what will happen? The rate of interest will differ, will change. Is it right? That much we have to know. It depends on the market conditions. We don't know whether sometimes it will be more or sometimes. What it's a, see, first understand what is a convertible bond. Convertible bond is nothing but, convertible instruments is, compound instruments is nothing but, we are having two characteristics. The first characteristic will be in the form of bond or loan. This bond or loan can be converted into equity. Is it right? At a predetermined number of equity shares. Initially, it will say, as a lender of the company, we have the discounted rate. Discounted rate is nothing but the you can put it as a we use the word, is it right? It is discounted rate. At what rate the value of the money will decrease. Is it right? It is nothing but the R. Is it time value of money? Is it right? At what? Now you assume, just for your reference, is it right? If R value is more, present value will be less. Is it right? How you are going to calculate present value? Present value is nothing but cash flow divided by 1 plus R. Okay? Cash flow divided by 1 plus R to the power of T. I will do only for 1 year. Okay? Only for 1 year. Assume the cash flow is how much? Assume the cash flow is how much? 100. Okay? We will first talk about the R. Is it right? We take R equal to 8% and R equal to 10%. We will say that 10% is more attractive. Is it right? It is not like that. Is it right? If you take 8%, PV equal to, what happens? 100 divided by 1.08. Is it right? Present value. Or, is it right? Or 100 divided by 1.10. Is it right? If you take that 100 divided by 100 divided by 1.08, it comes to how much? It comes to 95.59. Okay? If 100 divided by 110, it comes to how much? 90.9. Okay, the value is less if it R value increases. Is it? This is the rule as such. This is what it says. Now you should not assume that yes, I'm getting 10%. I'm getting more returns. Is it? I'm getting 15%. I'm getting more returns. No, it is not like that. If you are getting more 15%, the value will be less. Okay, just keep that much in mind. Inshallah, we'll work it out. Is that these convertible bonds are according with respect to split accounting. Is it what happens? Split accounting means they are dividing it into the form of equity and in the form of liability. There is it a no. There is a liability or debt element. Definitely, we are talking about the loan. Is it that we are talking about the bonds? Is that with which has been issued? Is it that we are converting bonds to equity? That is what it says. We will not only have the liability debt, but also we have the equity. That is the reason we are talking about the compound. Compound means we are having both the element of debt and both the element of equity. Initial recognition, always make it a point. Always we are going to take it in the fair value. Is that this is the lifeline which you are going to use all through the time. Is it? And the fair value is what is the fair value? The fair value is nothing but the present value of the future cash flow. That is why we are calculating present value, because in the next question we'll talk something on the present value. Okay. The equity element is equal to the loan. Definitely, the amount will not be any plus or minus. You are converting amount to point to point. Is that how you are going to measure subsequently what we have done in the last case? Is it right? In the previous cases, that is the initial value, column number 2, effective market rate of interest, effective rate minus the interest how much we have paid. Is it? The formula will remain same as such. Is that the formula will remain same as such? Is that now what is the compound instrument? You have the we have the two base characteristics with respect to the loan, specifically loan or bond. Loan is converted into equity shares or bond is converted into equity shares as such. Is it? They gave you a small question. Convert company issues convertible loans. How much? They pay interest of how much? They pay interest of 2%. Fine. They pay interest. This is nothing but the finance cost. Is it? They pay interest of 2%. In arrears means after the year. This see now you will have another new concept is there. Arrears. Arrears means at the end of the year. Is it? They will mention very clearly if it is at the end of the year or it is at the beginning of the year. Okay. The market rate is how much? This is nothing but the effective rate. Is it right? This is nothing but the effective rate is 8%. For an equivalent debtor without the conversion option. Okay, no conversion option. The loan is how much? 5 million is repayable in full after how many years? 3 years. Or convertible to equity. If you are you have two options. If you want to convert it in no conversion or conversion. Okay. Discount factors is how much? 8%. See, the discount factor is nothing but what? Just imagine, is that the same rule we are applying? 1 divided by 1.08 to the power of 1, we will get this one. Is that 1 divided by 1.08 to the power of 2, we will get this one. Is that 1 divided by 1.08, is that to the power of 3, we get how much? This one. Is it right? Now, what we have to do, we have to make sure that how it is going to be worked. See, split the loan between debt and equity at inception, okay, at the beginning, and calculate the finance charge each year until the conversion or redemption. Is it? Until the conversion or redemption. Is it? We will just make how the things will work. Fine. Now, if you do the things, what will happen? See that at inception. Is it at the inception? Is it? Now, this is the solution. We have to take year, is it right? We have to take how much? Cash flow. Is it? You have to take cash flow. We have to take what? Discount factor. Is it? Discount factor at 8%. Is it? At 8% and the present value. They are talking about 2%. Is it right? How much they are talking about? 2%. What is the how much is it will come if we take into consideration 5 million? Is it right? 5 million into 2 by 100. Is it 5 million equal to 2 by 100? How much will 1, 2, 3, 4? 1, 2, 3, 4. 2 5s are 10. Is it right? This is what it's happened. This is nothing but the finance cost. Is it? You can put it as a finance cost or you can put it as a cash flow. Is it? Finance cost or you can put it as a cash flow. Is it? This is what? How much is the cash flow? Cash flow is how much? Cash flow is how much? For this is cash flow is 1 to 3 years. Is that 1 to 3 years? Now, if you take into consideration, make it year 1, year 2, and year 3. First year it is going to be 100,000. Second year it is going to be 100,000. Third year will be how much? We have to repay. Is it right? We have to redeemable. Is it right? Redeemable means in the year 3, you will have the principal plus interest. Is it? You have the principal plus interest. It means what? You will have 5 million. Is it right? You have 5 million plus you have 100,000. Is it? How much you will get? You are getting 5,100. Is it at inception, at the beginning? Okay, we are talking about that at the beginning. What is the discount rate they have given? 0.926. Is it right? 0.857. How much? 0.857. 0.794. Is it 0. For present value is nothing. See, this is it at one? Whoa. It is happening like this. Allah mia. Okay. Lamia. Fine. No problem. Okay, nothing else. Inshallah. Okay, no problem. Inshallah. Not 1 minute. Okay, 1 minute. 1 minute, please. At the inception. Is it right? At the inception. Fine. At the inception, where we have calculated that all has been gone. Fine, no problem. Okay, no problem. Is it? This is the I'm facing my in my print. Is it right? And this is the finance cost. Is it right? This is the finance cost and this is the effective rate of interest. Sorry, 1 minute. Is that what we have done? We have done 5. Is it right? We have calculated cash flow here. Is it right? We have calculated cash flow here. How much we have calculated? 5 million. 5 million times 2 by 100. It comes to 100,000. Is it right? Year 1 to 3. Okay. Year 1 to 3. Fine. At the inception, what we have done? We have done the year. We have done the year cash flow. Is it right? Year cash flow. We are talking about the discount factor at the rate of 8%. We are talking in terms of present value. Is it right? Make it a table. Is it right? Is it right? Is it right? Now, this is the reason I have taken. Is that this is column 1, this is column 2, this is column 3, column 4 is nothing but 2 times 3. Okay, column 2 times column 3 as such. Now done. Okay, this is 1, 2, 3. Okay, 1, 2, 3. How much is the cash flow? 100, 100,000 and 100,000. Is it right? Sorry, 5.1. Is it right? The principal is 5 million plus the interest is, means when you are paying at the end of the 3rd year, you will pay the principal as well as it is only applied to bonds. Okay, when you are talking in terms of bonds, is it right? When we are talking in the bonds at the maturity, is it right? At the maturity, the principal plus interest will be repaid. Okay, now what is the discount values? There again 0.926, 0.857. is it right? 0.857 and 0.794. okay, how much you will get? It gives how much? 926. 1 minute. How much you will get? 92,600. Good. 92,600, 85,700, and how much? How much the last one? 80. Is that 85,700 and 51. Is it right? 51 404 9400. 404 9400. Okay, total, how much you'll get? The total, how much you'll get? The total is 0 0 0 4 11 7 11 7. Is it right? No, how much? 4227700. okay, 4227700. fine. This much is what? This is the amount of debt. Okay, this is the amount of debt. Is it right? Present value of debt. Total is how much? Is it right? Total is how much? Total how much we have to repay? Is a total amount. How much we have taken? Total amount of debt is how much? This is the present value of debt. Okay, this is the present value of debt. Present value of debt. Okay, this is the present value of debt. Total amount of debt is how much? Total amount of debt is 5 million. Okay, total amount of debt is 5 million. How much is the difference? How much is the difference? If you take the difference, how much will get? 0 0 3. Is it right? 2 7 Is it right? 772 300. Good. Is it right? This is the amount of equity. Is it right? This is the amount of equity. If you take this into consideration, this is going to be called as a step 1. Is it? This is the step 1. Okay. Fine. Next. Are you clear about this? Is it okay? Are you clear about this?